Primo and Gaines will round out today's session. I've got StephenBigalow up next. He's projecting price targets with candlestick analysis. Y'all know he's we are recording today while we wait for Steve. I want to remind y'all, though, you know, we are super.
Make sure I've got the box. There it is. The first question I usually ask everybody is whether they have seen my presentations before, just so I have a gauge of how fast or slow to go on each chart. So it looks like 75%. Yes, okay. All right, so I'll try to kind of describe some of the signals and patterns for the new folks. So we're kind of in the next step of how do you project where your price target is going to go. And candlestick analysis is basically a very simple analysis of what human nature is doing. And I always start my presentations by saying prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. So we know that the candlestick signals allow us to see which direction or when a reversal has occurred, and we want to know what the price target is for a couple of reasons. One, we want to see if that trade is worthwhile in the first place. Now, if the candlestick signals, logically, if the candlestick signals work, that means if you've got a chart that looks great and it's got an upside potential of 4%, or another chart that has an upside potential of 40%, obviously you want to go with the one that has a much bigger price target. And secondly, what we want to see is because candlestick signals show us exactly where investor sentiment is turning positive, we want to see the areas where they have a high probability of turning negative. So we want to see what the targets potentially are, so we get a little bit more diligent as far as seeing what the signals and patterns are doing when we get there. So when we're doing analysis of trend indicators, I tell people you can trade any trading program that you want. You've got some very good speakers on today, and if you take candlesticks and overlay whatever you're trading, it's going to be immensely more clear what's happening in that price trend. So as we're going along, I forgot to add that if you have questions, feel free to ask as we're going. But if I'm analyzing a trend, I want to see what the signals are telling me, what the patterns are telling me, where we are in stochastics. Obviously, a candlestick buy signal in the overbought condition doesn't mean very much. The Japanese rice traders just tell us if you see a candlestick sell signal in the oversold area, the probabilities are pretty strong you're going to be in for a reversal. Then we can use everything else that everybody else is watching on a chart, whether it's trend lines, moving averages, anything that is a potential target. So these are the 12 major signals. As out of the candlestick universe of 50 or 60 signals, if you just learn these 12, don't spend your mental energy on learning all of them, because they don't occur often enough to even make it worthwhile. But there's two advantages to candlestick signals. One, they show a graphic representation of when there's been a change of investor sentiment. And two, because the Japanese rice traders have developed these signals or analyzed these signals over the last 400 years, not only do they show you visually where a reversal is occurring, but they tell you what the psychology is that created those signals. So with that combination, you've got a very powerful grasp of what's happening in a candlestick or in a reversal. The kicker signal is your strongest signal, just because it's been kicked in the opposite direction. So if you take that same information, that each individual candlestick signal creates a chain, or it tells you what's going on in investor sentiment, patterns also work extremely well. We use the moving averages. You'll see on my charts they're very simple. We've got the 200, the 50, and the 20-day simple moving averages. And the reason for that is every major money manager around the world uses those moving averages to make decisions about their portfolio. The advantage we have is we can see exactly what their decisions are at those levels. the 8 exponential moving average, the T-line, will go into, which is one of your highest. Well, in the 40 years that I've been trading, the T-line's been the most effective support and resistance level, and I'll go into that. Steve, yes. Candlestick signals and patterns are not the evaluation of a market. It's the evaluation of what investors are doing in that market. So whether you're trading stocks, bonds, futures, currencies, tulip bulbs, anything that has fear and greed, candlestick signals work extremely well. So again, the more technical elements that we can put into our evaluation, which we can do very quickly visually, the higher the probability that we're going to be in the right trade at the right time. So market or moving averages have truisms. We know that if a moving average acts as a support and it's breached, they'll probably come back up and test it to see if it's going to act as resistance. So if you've got this trend going on and they break through the support level, what do? We can see where the buy signals are starting, a bullish engulfing, a hammer harami. Where do they come back up to? Right smack dab to the 50. Why? Because that's where everybody and their brother is watching to see what's happening here. We can see more concisely what's happening here. Notice we have a doji, a spinning top, a hanging man, and then failure. What they tell us, there was indecision up here. Stochastics are in the overbought area. If they didn't go through, it was time to take profits. They were pulling back. And where did they pull back to? Right smack dab to the 20-day moving average. How did we know it was going to support there? Or it was supporting there? There's our bullish harami, one of the 12 major signals, telling you the selling has stopped. So there's a very simple rule. If they fail at a moving average, and they come up and test it the second time, they'll usually go through. How could we tell? Because that candle told us there wasn't any indecision at this point. Then what's our next criteria? If a support level or a resistance level is breached, they'll usually come back and test it to see if it's going to act as support. Did it tell us it was acting as support? Definitely. There was that bullish harami again, telling us the selling has stopped. We could be buying with much more conviction immediately on the next day. So anytime we see a resistance level, like a 200-day moving average, we can see what type of signals. There's our shooting star. Next time it came up through, same scenario. Came up through, came back, tested it. There's our bullish harami doji, telling us they weren't coming back down through the 200. Our uptrend was still in progress. This is the blue ice failure. When they fall through the ice, this was named by my late friend Dave Elliott, that if somebody falls through the ice, what's the first thing they do? They come up to try to find the hole they fell through. If they fail, where are they going to? To the bottom of the pond. Once they get to the bottom of the pond, now we can see what's happening there. So this is what he named the blue ice failure. Now I always would help him in his reminder of people what the blue ice failure was when we were doing live sessions around the nation. I would just always illustrate the story of how do you catch a polar bear. Well, you cut a big hole in the ice, and then you take a can of peas and you spread it around that hole. And when the polar bear comes down to take a pea, you kick him in the ice hole. It wasn't a real technical explanation, but people remember the blue ice failure. This chart shows, Dan, I don't know which one it was. Remember, we're buying the signals. Everything else is a confirming indicator. I'll see if I can find a kicker signal somewhere along here. So anyways, notice what happened right here. Right smack dab on the 200-day moving average, a huge doji hammer type signal. Is this telling us it's time to buy? Well, if we wake up, this was, I think, the Dow. We wake up the next morning and we see the pre-market futures are trading positive. We can be buying immediately because what type of signal are we going to be looking at? That's our morning star signal. Big down day, a day of indecision, and a big up day. Where's our next target? Probably coming back up to test the 50-day moving average. So if we're in a downtrend and we see it's time to buy, and we see at the first major resistance level, there's our shooting star signal. Two things. What did we want to see if this was in an uptrend? That they stayed up above the 50. The fact that they closed it back below the 50 and did a candlestick sell signal and did that when it was up in the overbought condition was a pretty good indication that they weren't going through. And what's our very simple rule of candlestick signal? If they confirm the next day, meaning continue selling, you close out the position, not only close out any long position, but you can start going short, because what did that tell us about our trend? We're still in a downtrend. So the moving averages act like magnets. Why is that? Because if you're a major money manager and you like this stock and you decided in your committee meetings that you're going to go ahead and buy 680,000 shares, and you see it pulling back, where do you think you're going to look to buy when it's pulling back? Probably back here at a major support level. So that's because nobody will be buying it until they get back to the support level. Will they be buying at the support level? Candlestick signals tell you exactly what's happened here. Again, there's our morning star signal right smack dab on the 50-day moving average. Stochastics in the oversold area. Opens positive, trading above this downtrending channel. These are all indications that they're confirming the buy signal off the 50-day moving average. So when you can utilize the information they're built into candlestick signals and then add other indicators that improve the probabilities, that makes holding on to a trend or knowing what your next target is going to be extremely strong. I don't know whether I did it yet or not, but the T-line is the 8 exponential moving average. Got a very simple rule, the T-line. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. So if we were long this, we'd be taking profits right here. What becomes our next target? Probably the next major support level. How come you don't use a 20-day SMA as your trend? The SMA, or the 20-day SMA, the T-line is more effective. That's the 8 exponential moving average. The 20-day will become more effective the longer a trade or a trend stays in progress. The T-line is the 8 exponential moving average. So if we're anticipating that we have a sell signal, we've closed out our position, where are we looking for the next support level? Probably back down here to the 50. If it doesn't hold at the 50, we're looking at the 200. That was a big down day a while ago, a couple of years ago in the Dow. But when the selling stopped, where do you think the next target was? They're coming back up to test the 50. We can see exactly what they did at the 50. There's our bearish harami telling us the buying has stopped. If we went long, we covered our longs. Now where's the next target? Probably down here at the 200. And what's our simple rule of the T-line? We can stay short. If we see a sell signal and a close below the T-line, we stay short until we see a candlestick buy signal and close back up above the T-line. So we're buying down here. There's our buy signal. We're buying in here. Where's our next target? Back up to the 50. Notice what type of signal we have at the 50, the doji. The doji is one of the 12 major signals and probably the most well-known. But the doji represents the indecision between the bulls and the bears. So that signal right there told us with stochastics in the overbought area, and they just touched the 50, that if it opened lower the next day, you're taking profits, and more than likely your downtrend is still in progress. So we also have different signals that can confirm what's happening in a trend. There's our doji confirm with a close below the T-line. This is what we call a doji sandwich. Notice that the next day after that big candle, they did a doji day, indecision. Well, there's a very simple rule of the doji. They're usually going to move in the direction of how they open after a doji. And if they open this lower and start trading lower, the magnitude of this candle right here and the magnitude of this candle right here are usually the same, thus the doji sandwiched in between. But what does that illustrate? Number one, it tells us they're well below the T-line. And two, we know the results of a doji sandwich. There's going to be more downside. So if we went short in here, do we anticipate the next target should be? Well, it could be here or it could be here. And once we get down here, notice what type of signals we're starting to see. The indecision again, the doji type days, and look where our stochastics are. We're down in the oversold area, in an area that tells us there might be a reversal about ready to occur. So the T-line, I want to come back to this because this is one of the most important facets of, what I would say, improving dramatically my profitability of investing. The T-line, again, is the 8 exponential moving average. You're in a downtrend until you can see anything else is going to either act as a support or not. And if it doesn't, you're in a downtrend until you see a buy signal and a close back up above the T-line. Let's see what. So the T-line has truisms to it. The further away you move from the T-line, the higher the probability it's going to come back and test it. So the whole function of candlestick analysis is looking for the patterns, kind of our double bottom, fry pan bottom. How long do we stay long? Until we see a sell signal and a close below the T-line. However, with the caveat that the further away you move from the T-line, the higher the probability it's going to come back and test it. So to wait from here back to here was a substantial giving up of profits. But if we know the factor that the further away we are from the T-line, the higher the probability is going to come back and test it, when we can visually see that we've moved too far away from the T-line on a daily chart, very simple. We flip to our 10-minute chart and watch the 10-minute chart. As soon as we see a sell signal and a close below the T-line on the 10-minute chart, we start taking profits, because if that's starting to begin the selling, where do you think they're going to move it back to? Back to the T-line. So remember, on most moving averages, if the further away they move from a moving average, the higher the probability it's going to come back and test it. Depending on your time frame of holding positions, once I see a bearish harami up here from the T-line, I'm going to take some profits with the anticipation they're going to come back down and test the T-line. You say confirm the next open. What time frame do you consider the open? Al, that's a function of which direction is the market moving. Are you in a bullish market? Are you in a bearish market? Are you in a sideways market? That's a whole nother training session we do on our website, is entry and exit strategies that confirm that your signal is working and you have a high probability that you're in the right direction. Tino, no percentage. All you can do is see that now you've kind of moved a decent percentage or a decent distance away based upon the relative movement of that price. And this comes back to the basic analysis that the Japanese rice traders have provided for us. Is where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. And that used to be me. I was the worst investor in the world. I was even a stockbroker for 8 years. And once I learned what the candlestick signals were telling me, all I had to do was turn my investing around 180 degrees, and I became a very successful trader, consistently pulling money out of the markets every month. Ronald, I don't have to. A Bollinger Band is a decent range finder, but the nice thing about candlestick signals is we know they work. There's one adage on Wall Street. If something doesn't work, it disappears very quickly. Candlestick signals have been around for 400 years. A lot of people are still just learning them, not because they were kept secret, it's just nobody ever paid any attention to them. So it wasn't a function of whether candlestick signals work or not. We know they work. It's just teaching people how to use them effectively. Let's see, what other is, if more likely to reverse far from the T line, also far from the, anything, the T line is depending on your time of trading. If you're a longer term holder, up here you might take profits because you're waiting for it to come back to the 50. If you're a swing trader like myself, I'm taking profits here, waiting to see what it does back at this level. Helen, we will be doing another 2-day online training October 18th, not October 18th, March 18th. Is the T-line above? It doesn't matter where the T-line is. Ronald, you can use either or. I've just used Stochastics for the last 40 years. And yes, you can review your old classes, Helen. I've used the Stochastics. You can use RSI. That was back to, we know the signals work, so whatever you want to put on your chart to analyze to see if it correlates correctly, you can go ahead and do, because you know the basis of your charts are going to work. Now what we're trying to do is just kind of refine them to make them work better. This webinar is being recorded. Yep. I used Stochastics at 1233, and that was nothing more official than one night 40 years ago. I thought, all right, what Stochastics tell me I'm at the top, and what Stochastics tell me I'm at the bottom? At that time, the common one was 1455, but that was slower. I'm a swing trader. 1233 seems to work for me the best, and it doesn't matter what time frame you're using. This could be a 1-minute chart. This could be a monthly chart, or anything in between. Candlestick signals are the graphic depiction of what investor sentiment is doing during a specific time frame. So I used to trade the E-minis on a 1-minute, 3-minute, 10-minute chart combination. I trade most of the futures right now off a 10-minute chart. I trade big stock positions off the daily charts. Are you going to have your best flashcards on sale? They're there. Let's see. What do you find? Whoops. What do you find the best stop strategy you've tried? John, very simple common sense, which is a whole other training session, which we usually do in the evenings, is we're not buying or selling based upon a percentage. A lot of people say, oh, you should stop out of your position if it pulls back 3%, 6%, 8%. The market doesn't give a hoot where you bought. What we want to see is, where is the position, or where is the area that tells me the bears have taken control? Do you want Stochastics to confirm your candlestick pattern? Yes. But you will find that when we buy a buy signal, it's usually in the oversold area. When a fry pan bottom or a J-hook pattern breakout, it's usually in the overbought area. You can use candlesticks with the cloud, yes. Do you use a 10-minute chart to exit a trade? Yes. And I don't know whether I've got those in here. I might have. How do you determine price targets? Based upon where are my stochastics, and if I know this is wave 1, I know what the magnitude of wave 3 is going to be. So these patterns, like the J-hook pattern is one of the top patterns, comes up, strong price move, does a J-hook. And notice what the nature of this J-hook is. When they started taking profits, and notice how far away we are relative to the T-line, taking profit, and then we see what it does when it gets back to the T-line. Notice how indecisive it is with the dojis and little inverted hammers. I don't mind selling out here. It used to be if I got out of a trade and it turned around and went back up, my first thought was, oh, they're not going to trick me. They're not going to get me out and then get me back in and then take it back down again. Now I know what human nature does. Strong price move, consolidation, and then this wave right here will usually be equivalent to this wave right here. So even if I've missed this move and I see this setting up, I know what the magnitude of this move should be. The T-line is the 8 exponential moving average. Are gaps on 5-minute charts important? TJ, usually an intraday chart isn't going to have a whole lot of gaps because it's continuous trading, unless something big or dramatic happens during the day. So moving averages are just kind of like the grid on your playing field. Comes up, we can see where it's time to take profits. We also see that it's time to get ready to get back in because notice what they couldn't do. They couldn't close below the T-line. So if they break through the 50, where's our next target? Well, if this is wave 1, wave 3 should be about up here. What happens when we get up here? If we see selling, we take our profits. I don't use pivot points. Candlestick signals, again, are the accumulative knowledge of everybody buying and selling. I use the candlestick signals. Then you can throw anything else you want on the charts because it's going to be additional confirmation of when or what the price move might be doing at that level. We were in Kiwi. There's wave 1. Notice our dojis down here, then a close above the T-line. Stochastics in the oversold area. Wave 1, bearish harami, pulls back, taking profits, coming back in. Again, there's our doji sandwich. Big day, doji, big day. What's that tell us? There's more upside. So when we get up in this area, what do we start watching for? Sell signals. Why? Because that candle or that move right there is about the same magnitude as that move right there. What moving average do you use for day trading? The same. This chart could be a 1-minute chart, a 10-minute chart, a 30-minute chart. It's all the same. It's what we call fractal. That everything on this chart, on a daily chart, looks exactly the same on a 10-minute chart. This is the T-line crunch. So we know if this is wave 1, it failed at the 50, pulled back to the T-line. When it came up through, we know what our target should be. Same magnitude as wave 1. Again, this is not rocket science. I always tell people, as long as you can see, you can analyze candlestick charts. And it's like I tell people, it's like the old couple that are getting ready for bed, and she's standing there naked in front of the mirror, and she said, look at me. My face is wrinkly, my arms are skinny, my butt is scrawny, my legs are spindly. And she turned around to her husband and said, is there anything nice you could say about my body that would make me feel good? He goes, well, your eyesight's still pretty good. So as long as you can see, you can analyze candlestick charts. The gray line is, this one is the 20-day moving average. What is the bottoming pattern that corresponds with a dumpling top? The fry pan bottom. I'll see if we've got it here. So this is what we call the bobble pattern. Notice when it got up here. How did it get here? They gapped up and did a doji in the overbought condition. What was the number one aspect that the Japanese rice traders informed us about? Where do most people buy? They buy exuberantly at the top. So as soon as it started opening lower, take profits, but notice how the T-line still acts as a support. So when they gapped it up through the bobble breakout, we were buying just because we know what the reaction should be. Now, does every trade immediately do this? Definitely not. But the nice thing about candlestick analysis is if we can graphically see where investor sentiment is building up, candlestick signals basically put us into a situation where we're in the right right position at the right time. Whoops. Oh, pshaw. I goofed up. There we go. Yeah, trying to get the question box over here. Hold on for a second. All right. The definition, again, of the T-line is the 8 exponential moving average. Now, I tell people, don't take my word for it. You can put the 8 exponential moving average on your chart just as easy as you can the 50 or the 200 simple moving average. Now, let's see where I've got it here. How much time do I have left? I guess it's plenty of time. So, again, we can identify patterns and identify what our next targets are going to be based upon wave 1 and wave 3 heading to what everybody else is watching. And it doesn't matter whether you're doing it on the 1-minute chart, 10-minute chart. I trade soybeans, I trade the dollar, all based upon the same reoccurring confirmation indicator that's been the most consistent throughout history. And that's the human nature. Human nature works the same way time after time. Jerry, put on the 9 EMA if that floats your boat. We just use the 8 because it's been working for us profitably for many years. What is the pink line and how do you use it? The pink line. Oh, little pink line. This is the this is the 3 T line, 3 exponential moving average. It becomes much more effective for using to confirm when it comes up through the 8 that it's time to buy, and the further away you move from the T line, the higher the effectiveness the 3 T line becomes. So I can analyze what's happening here, but notice I haven't seen a confirmed sell signal. If it goes through the 50, where is it going to? The 200. What did it do at the 200? Told me it wasn't going to act as resistance. I could continue to stay long. So the information that is built into candlestick signals dramatically improves your analysis of what's going on in a trend. So if I see something like this, where I can see the double bottom, this is what we call your best friend signal, one of the quantitative signals that we point out. That if you see a doji in the oversold area and they gap it up, that's your best friend. Not only because you're going to have a high probability that you're going to be in an uptrend, but usually a very strong uptrend. I say usually. Everything based upon candlestick analysis is that over the years, it has shown you what the high probability moves are going to be. But we can see visually what happened when it got back up here to the 50. Bearish harami and sold off. So it wasn't a double bottom. Now we can analyze we should be out of this trade and that maybe we're in a trend channel based upon what happened right at that target. The stochastics are 1233. Do you use volume? No. Now, I use volume. A lot of people say, I want to see the volume going up as the price goes up. Volume and price have absolutely nothing to do with each other. If you've picked a stock where everybody wants to get into it and nobody wants to sell it, it's going to go up in small volume. Now, there are times where you might see a big reversal signal at the bottom and you see big, huge volume. That's just added confirmation that there's been a dramatic change of ownership, kind of giving you a little bit more confirmation there's a change. So it doesn't take much to analyze trends of the market or anything that you're trading. Evening star signal. Notice how far away we moved from the T-line. Close below the T-line. Where's the next target? 50? Well, at the 50, our stochastics are still heading down. Where's our next target? The 200 in the oversold area. And what do we see down here? A doji. If you see a doji in the oversold area, you start watching for a reversal. The next day, we see them open up positive. We're buying immediately, which does 2 things for the candlestick investor. One, if we're buying right here, we're getting in early on any big move. And 2, if this doesn't confirm, we're right back out with very small losses. That old sage advice that most money managers will give you, cut your losses short and let your profits run. The only problem is in the 40 years that I've been investing, I've never seen one tell you how you cut your losses short and let your profits run. Candlestick signals have very simple techniques to do that, based upon. It's all done based on common sense, human nature analysis. So once we get in there, we stay long until we see a sell signal and a close below the T line. Or you can use it whenever you can identify your targets, like a trend channel. If we can see up here that we had a hanging man and then he closed back below the T line, and we had a place to draw a line through there, you can draw your parallel line through the bottom. Where was our next target? In this area. What happened when we got down here? Lots of indecision, dojis, and a close back up above the T line. Where was our next target? Well, the 50, which it went through. What's our next target after that? Back up here to the top of this channel. So is that where it's going to top out? We have no idea, but we can see exactly what happened the next day. There was a bearish harami, and what other elements were we looking at? Notice how far away we were from the T line. So a bearish harami, and what's our simple rule of a harami? If they open it lower the next day, they're confirming. So where's our next target? Probably back down here to the T line. So we're taking profits up in this area. Fails the T line, if we're short, where's our next target? Notice what happened down here. A doji right off the 200-day moving average, right at the bottom of this trend channel, a big reversal signal, morning star signal, and a close above the T line. Now where's our next target? Probably heading back up again. The light green line, now on some of them, the light green line is that 3 exponential moving average. What is the sell signal on this one? There was a hanging man confirmed. There was a bearish harami, which is in Western terminology, inside day, where it opens at or below the previous day's close and closes above the previous day's open, especially if it's occurring up here in the overbought area. These are daily charts, but that's just because they're the fastest ones to show illustrations. This could be a 10-minute chart. This could be a 1-minute chart. This could be an hourly chart. Depending on what your trading strategy is or your trading time frame, if you're trading, now I usually trade off the 10-minute chart, but if I'm looking at the dollar, which moves a lot slower, I might use a combination of the 10-minute chart and the 30-minute chart. Whereas if I'm trading soybeans, I might be using a 10-minute, 5-minute, 1-minute chart combination. The moving averages on here are simple. The 50, the 200, the 200, and the 20 are simple moving averages, and that's because that's what every major money manager uses. The T line is your 8 exponential moving average. What's in upper left corner? What's up in upper left corner? I don't know. That's just the numbers of what's happened in the market on that day. This is what we call a McMuffin. There's our morning star signal. Big down day, a day of indecision. The third day closes more than halfway up this candle, and it closed above the T line, coming out of the oversold area. That's an extremely high probability reversal signal. Then notice what happened right afterwards. There's our doji. The next day we had a same magnitude green candle as this right here, or doji sandwich. So you combine the two, you basically have a morning sandwich or a McMuffin. In either case, the expectation is from a morning star signal, if it confirms, you're going to have an uptrend. Doji sandwich usually indicates there's going to be more upside. So using the information, again, on a doji sandwich, remember what our simple rule of a doji is. The price is usually going to move in the direction of how they open it the next day. So if I see a doji smack dab on a major resistance level, and they open up positive, I know the probabilities are pretty strong they're going to go positive. What's that tell me about my resistance level? It's not there anymore. It's still got more upside. Do you read the 200 and the 800 SMA as fair value? No. The 200 and the 800 SMA as fair value? Nah. I'm only interested in what's happening right here. My trade may only last 2 to 10 trading days, depending on along the trend line. So I don't care about all the longer-term indicators. This is what we call the classic pattern. There's our fry pan bottom. Somebody was asking, what's the opposite of a dumpling top? It's a fry pan bottom. You couldn't trade this one way or the other if you wanted to, until we started seeing buy signals at right about where the pattern started to get very indecisive. And what do we expect coming out of a fry pan bottom? A very strong price move. Then what happens? We start seeing profit taking. Pulls back right smack dab to the 50 and now starts back up. What's that creating? A J-hook pattern. What's the prerequisite for a J-hook pattern? A very strong price move, a pullback. And if this is wave 1, this will likely be the magnitude of wave 3. Now, will it go to that same magnitude? Definitely not. The number one criteria for buying and selling is the candlestick buy and sell signal. So if it comes up here, right here, halfway up this, when we see a sell signal, that's our first criteria for getting in and out of positions. I see a lot of moving averages that are, what are the main ones? These are all the same, 200, 50, and the 20. Those are the ones that most money managers use. So if I see a trend, and I'm buying when it came up through here because it broke this downtrend, where's my next target? Probably the 50-day moving average. What does it do with the 50-day moving average? I can see exactly what happened, a bearish engulfing signal. So if I was long and I covered my long position, where do you think my next target is going to be? Probably this downtrending channel. So if I went short up here, as soon as it got down here, I don't necessarily have to have a candlestick daily signal. What was our simple rule? The further away we move from the T-line, the higher the probability is going to come back up and test it. So if I'm way down here and I'm in the oversold area, I flip to my 10-minute chart. And as soon as the 10-minute chart does a buy signal and it closed back up above the T-line on the 10-minute chart, I'm taking my profits. Why am I doing that well before this creates a reversal signal? Because of the factor that we've moved too far away from the T-line. What type of trading platform do you use? Jamie, I don't understand. I use Thinkorswim just because I can trade stocks, options, and futures all out of one account. The fry pan bottom and cup and handle, all it is a fry pan bottom and then a little cup at the end of it. So if you get to the, let's see if I can go back. If I get here and it does this, same thing. That's the cup and handle. But this is the fry pan bottom, and we're buying. Remember, we want to be buying a buy signal when the stochastics are in the oversold area. Usually a fry pan bottom will break out when you're in the overbought condition. Profit targets, if I'm buying here, everybody says, well, what's your next target? I'm looking to see where everybody else is buying. Once it gets up here, I'm more apt to be much more conscious of, is a cup deeper? No. Oh, yes, the cup is deeper. The handle is usually very shallow. I'm watching to see what type of signals we're starting to get selling. Where's my next target? Probably back down here to the 50. There's our slow curve breakout. Notice where it broke out. Through this resistance level on a slow curve, we're buying right here. Where's our next target? We want to see what happens up here. Notice what's happened up here at the top of this trend. Hanging man, doji, doji. Lots of indecision. What's our rationale for taking profits here? What's the worst case scenario? The probability to say it's time to take profits. Worst case is we close it out here, and then all of a sudden trades back up here. We can always buy back. We're not trying to maximize our dollar on every trade. We're trying to maximize our dollar profits for our account, which at times say close out a position when the probability say it's time to get out, and or there's our doji sandwich with a close below the T-line. Where's our next target? Probably the 50-day moving average. Once it gets down there, we start watching to see what signals are occurring at that level. The gaps also improve our our targets. Gaps usually get filled. So if I'm long here and I see it reversing, well, that's what's my next target? There's my left-right combo. That's a doji followed by a bearish engulfing signal. A very high probability reversal. So where's my next target? Well, that's when you can throw Fibonacci numbers on. You watch to see which trend or moving averages. Anything that could be a target. Are they going to be a target? We don't know. But if it got down here and I saw a hammer or doji and they started back up, then I could pretty well conclude that was the reversal signal at that level. This was gold. Notice what happened right at the breakout at our first target. There's your big fry pan bottom. If we're buying right in here, notice what happened when we went through our first target, the 50. Came right smack dab back to the 50 with a bullish harami, doji sandwich. Where was our next target? Up here. This makes it very clear that when they got to the 200 was not going to act as resistance. It went right through. How long do we hold this? Until we see a sell signal and a close back below the T-line. John, I use Thinkorswim at Ameritrade. That way I can have my money all in one account. So if I know this is my fry pan bottom and this is my J hook, what can I assume is happening? That I've got a classic pattern. That if I'm buying right here, what I expect this move to be? The same as this move right here. Again, this is not rocket science. Human nature moves the same way time after time. What charts are you using on the presentation? I use CQG, which is the grandfather of all the charts. A lot of the brokerage firms use CQG as their feed. You don't need to use CQG. They're just good for illustrating these type of things. And it's cost me like $1,300 a month. A fry pan bottom is usually a big, slow, rounding bottom at a bottom of a trend. A slow curve is usually in an uptrend, and then it creates a little slow curve, which is much shorter, and then breaks out to the upside. The 200 is the red. The blue is the 50. And the gray is the 20-day simple moving average. Now, there's one thing that I always like to illustrate to people, or profess to people, is that if candlestick signals are the graphic depiction on what's happening in human nature, and the Japanese rice traders have made it much more clear by boxing in the open and the close, and the T-line works very effectively for trend, support, and resistance, almost like a Fibonacci natural number of human nature. When you combine those two, you've got an extremely powerful combination that tells you what you're doing as far as that trend. Jamie, that is expensive, and I've been doing it for years. Somebody pointed out that's a 66 Cadillac convertible that you could be buying, but it makes presentations like this go much faster. A fry pan is the same as a rounded bottom is what they call it in Western terminology. So if I've got a wave one and I see buying, there's my doji sandwich, J-hook pattern, I expect wave three to have the same magnitude as wave one. This one, same scenario. Wave one, wave two. That's what we expect going on in wave three right now. I think that's just from this past week. Oh, no, there was that breakout. And then this was Friday. And again, notice where we were on Friday. So we went to our 10-minute chart. We started taking profits up here as soon as it came back below the 10-minute T-line. So when is the sell indication? Kiwi, wave one, wave three getting to be about the same magnitude as wave one. We want to start watching for profit taking. Scoop pattern. We know what should come out of a scoop pattern. Usually a very strong price move. So if this is wave 1, that would be wave 3. So there is nothing, the doji is consolidation. The doji is indecision between the bulls and the bears. I use slow stochastics. And again, candlestick analysis, if you put it on any of your trading programs, whoever you're using to trade with, if you throw candlesticks, say, I use candlestick signals as my top indicator, and then use everything else as confirmation. So I think that's about all I got. What time is it? 11:55. I think Pat, Jeanette, did you get the link for our special? We've got a special. I've got a whole.
Hey, yeah, I'll post that for you. Sorry.
Okay, great. So I think it's normally $147. Pat's got it on here for a special of $17, and I think that also gets you 30 days free trial, or maybe a 1-week free trial to our website. So we've got a chat room that we have open every single day. We got quite a few good traders in there that spot the best candlestick charts. We also have a room for just discussing option trades. Every Monday night, I do a live session showing what the market's doing, which futures are acting the best. We do the same. That's for members on Monday night. Thursday night is open to everybody. I put out 2 or 3 stock picks every day and do it in a video format, not so that people have stock picks, but so that everybody has a kind of a learning process of why those picks are being recommended. Yes, this is good for forex, Maurice. You just won't see the gaps that happen because it's continuing trading. Yes, we show how to people one of our training sessions or the members areas. Show people how to scan for the best possible trades. Thank you, Jack. But as I said, I put out 2 or 3 stock picks so that people can continue to learn. We found that if you just tell people what to do, they don't understand why they're doing it. And I kind of equate that to the cop that was standing on the street corner and sees this drunk weaving down the street, blows his whistle, pulls the guy over, walks up to the car, looks in the back seat, and there's a penguin sitting there. And he goes, "What the heck are you doing with a penguin in the back seat?" And the drunk said, "Oh, I found him out on the street, and I don't know what to do with him." Then the cop said, "Well, take him to the zoo." He said, "Oh, that's a good idea." The next day, the cop's standing on the street corner, and here comes this drunk weaving down the street again. Blows his whistle, pulls the guy over, walks up to the car, and there's the penguin still sitting in the back seat. He said, "I thought I told you to take the penguin to the zoo." Drunk said, "I did. He liked it so much today we're going to a baseball game." So if you don't know why you're doing something, it doesn't do you any good. So we will be doing the full 2-day training session on March 18th and 19th. So I guess that's about all I got. I guess we got 2 minutes for questions. All I can tell you is years ago I was the worst investor in the world. And when I started looking at candlestick signals, which back then nobody knew about, I kept looking at them and saying, wait, this makes sense. And the more I looked at them, the more sense it made. And I would use it back then when the chat rooms just started on the internet. I would ask people rhetorically, why isn't everybody using candlesticks? And they said, well, there's too many of them and they don't always work. So I figured out there were too many of them. That's why we narrowed it down to 12. But more importantly, if they didn't work, we wouldn't be looking at them today. So it's not a function of whether they work or not. They work extremely high percentage